a comprehensive look at trends, fund profiles, and more in Exploring ETFs.
Hi everyone, welcome to Exploring ETFs. I'm Neena Mishra, and today we are talking about quality ETFs and why it makes sense to invest in quality stocks and ETFs for the fourth quarter. Now, we all know that September has been a very volatile month for stocks, and this roller coaster ride continues. Just last Monday, the S&P 500 and the Nasdaq, they had recorded their worst one-day declines since May. Those were basically on concerns surrounding the Chinese property developer Evergrande. And after that, later in the week, the stock indexes, they staged a very impressive rebound when those concerns ebbed, and also the Fed signaled that it is ready to taper its massive asset purchases. So normally, people think that tapering should be bad for stocks, but actually stocks rebounded after that announcement, basically because number one, taper indicates Fed's confidence in the economy, that the economy is strong enough that they can slowly start withdrawing these extraordinary policies that they had introduced for the pandemic. And secondly, the taper has been telegraphed by the Fed very effectively this time. So investors are prepared, that has been priced in, and investors know that while this extraordinary stimulus is being withdrawn slowly, ultra easy monetary policies are still in place, and rate hike may not come for quite some time. Rates will stay at ultra low, near zero levels for quite some time. Now, looking at the fourth quarter, it seems the volatility may continue because the economic growth is slowing down. And plus the taper and Delta variant also remains a big uncertainty. That being said, stocks are still the best place to be in. Tina, there is no alternative to stocks, and FOMO, fear of missing out. Those are the two main factors that are responsible for buying on dips, because there's a lot of cash on sidelines. Stocks look very attractive compared to bonds and other asset classes, and ultra monetary policy is still in place. And looking at valuations, yes, they are stretched, but this year, the rally has been driven mainly by earnings growth. So if you compare valuations compared to those at the start of the year, valuations have not been stretched for this year. So they still look okay. Now, quality stocks, they typically do well when earnings growth starts to slow and economic growth starts to slow. So that is why it makes sense to look at quality stocks now. But overall, the portfolio should have a barbell approach, allocations to both growth and value, because this year we have seen these continued in and out rotations out of and into value and growth. So it is very difficult to say whether value or growth will outperform for the fourth quarter. So have exposure to both, maintain a diversified portfolio of stocks. So let's take a look at 3 quality ETFs that invest in stocks that have very strong balance sheets and have been delivering excellent earnings growth in all kinds of environments. So the first one we are taking a look at is by iShares. It is the most popular quality ETF, ticker symbol QUAL, QUAL, very easy to remember. It holds large and mid-cap stocks with positive fundamentals. Very popular with almost 24 billion in assets and very attractively priced at 15 basis points expense ratio. Now let's take a look at this ETF by going to the quote page on Zacks.com. You can read our research report articles, and then using the link you can go to iShares webpage for this ETF and learn more. So it positive fundamentals it defines by high return on equity, stable year-over-year earnings, and low financial leverage. Now looking at the portfolio, you will see Facebook, Microsoft, Nike, and Apple. These are the top holdings in the portfolio. Information technology is about 29%, then healthcare and consumer discretionary at 13 and 12% respectively. The second one that I'm highlighting is by Invesco. The ticker symbol is SPHQ. S&P 500 high quality companies. So S&P 500 companies with the highest quality score are included in this ETF. This also has an expense ratio of 15 basis points and very popular with 3.1 billion in assets. Again, to learn more, you can go to the quote page and the Invesco web page. They have some good research on quality stocks. You can take a look at that. So basically, it defines quality on three fundamental measures: return on equity, accruals ratio, and financials leverage ratio. Now looking at the portfolio, you will see it has a higher allocation to IT and then financials and healthcare. So you get a slightly different type of portfolio. So if you already have a lot of exposure to IT in your other holdings, maybe take a look at Qual. Or otherwise, if you like IT, then SPHQ. Microsoft, Apple, and as I mentioned, it has a higher allocation to financials too. So then JP Morgan, Procter and Gamble, and Visa, MasterCard, Bank of America, these are the top holdings in this ETF. The third one that I'm highlighting is by JP Morgan. This is one of the cheapest in this space with an expense ratio of just 12 basis points, but it is slightly smaller compared to the two giants that we discussed earlier. 388 million in assets, and this uses Russell 1000 index as the basic index and selects companies from that index with the highest quality score. And let's take a look at this ETF, what exactly it tries to do. So this focuses on company with strong quality and profitability, and taking a look at the portfolio, you will see it has 268 holdings: Microsoft, Alphabet, Nvidia, Facebook, and Apple. These are the top holdings in the portfolio. And looking at the sector exposure, this has about 30% exposure to technology, and then consumer discretionary and industrials. These are the other top sectors in terms of exposure, portfolio exposure. Now on the last slide, I have the comparative performance over the past year compared to the S&P 500 index. And interestingly, they all have delivered almost the same performance over the past year, despite a slightly different portfolios, despite slight differences in the portfolios, but that doesn't mean that there would be difference in performance going forward. So we will see that all these ETFs have delivered performance around 35-36% over the past year, which is same as the S&P 500 index. But that could change in the fourth quarter when quality stocks are expected to do better, and in 2022 as well. Thanks for watching. Make sure to check out zacks.com/promo for an interesting offer, and also make sure to subscribe to our videos, our video channel, so that you do not miss anything. And I will see you next week.